Welcome to this Iron Financial Explainer. Our mission here is incredibly simple. We want to help you forge a much stronger portfolio and cut right through the market weakness that's trapping so many investors right now. Today, we are looking at the absolute bedrock of the retail sector. We're breaking down Walmart's Q1 FY2027 earnings. I'm your lead analyst. And look, when I dive into these numbers, I am looking at a massive, ground-up structural transformation. Walmart is no longer just that traditional big box store you grew up with. They're currently doing the heavy lifting to completely rebuild themselves into a high-margin tech and advertising platform. And I'm your market skeptic. Look, I'm going to be honest with you. Whenever a massive legacy brick-and-mortar giant suddenly claims they've evolved into a tech platform, my radar instantly goes up. We've seen that trick before. Is this genuine structural integrity we're looking at, or is this just corporate hype designed to distract us from the very real cracks in their armor? Cracks being caused by relentless inflation and massive supply chain nightmares. So today, we are going to drill down deep into the actual financials. We aren't just going to read you the top line numbers and celebrate. We are going to aggressively stress test them. We need to know, is this stock a foundational opportunity, or is it a value trap? Let's find out.
Okay, let's dive into this. Here is our blueprint for today's explainer. Section 1 is the retail bellwether. Section 2, driving top-line growth. Section 3, the digital profit engine. Section 4, margin pressures and headwinds. And we'll wrap it up with Section 5, the future outlook. Let's jump right into Section 1, the retail bellwether, where we're setting the global economic stage. When you are trying to construct a durable, completely weather-resistant portfolio, you absolutely have to understand the macroeconomic foundation first. Walmart's massive, frankly unparalleled scale makes it the ultimate barometer for the entire global economy.
Right, it's that old saying, when Walmart sneezes, the global supply chain catches a cold. They aren't just reacting to market weakness. Their earnings reports literally define what that market weakness looks like for the rest of the retail sector. If there are any cracks in the everyday consumer's wallet, this is exactly where we're going to see them first.
Spot on. And that immense economic footprint is quantified right here by the sheer force of this first number, $177.8 billion. That is their Q1 FY27 top-line revenue figure. It represents a 7.3% year-over-year growth that completely crushed market expectations, which were sitting down at $174.9 billion. We're talking about an incredibly solid foundation to build on.
Hold on, let me jump in right here, because we need to be careful. A 7.3% jump to $177.8 billion sounds like an absolute top-line triumph, but we really have to ask the critical question. Is this actual organic growth, or is it just inflation artificially pumping up the price tags? Because look, if they're just taking higher supplier costs and passing them directly to the consumer without moving any more actual volume, that is not structural growth. That's just a mirage.
And that is exactly the kind of stress test we need to apply. But honestly, the data holds up beautifully under that pressure. Management reported that U.S. comparable sales were up 4.1%. And here's the crucial part. This includes real growth in both transactions and unit volumes. Think about it for a second. If your revenues are up just because you hiked your prices by 10%, but you actually sold 5% fewer items, well, your foundation is cracking. You're bleeding your customer base. But Walmart is seeing everyday people actively buying more items more frequently. They are physically moving more goods out the door in a highly inflationary environment. The structural integrity of this revenue beat is completely sound. To put that staggering $177.8 billion into perspective, let's take a look at the actual physical foot traffic that's generating it. We are talking about 255 million weekly customers spread across 19 different countries, visiting more than 10,500 physical stores and e-commerce sites.
That scale is almost hard to wrap your head around. 255 million people every single week. That means their internal data set on global consumer behavior is practically bulletproof. When we analyze these shopping baskets, we are getting a real-time, ground-level read on global inflation, consumer stress, and fundamental spending shifts. If you really want to know how the average household is surviving this current economy, you don't look at luxury retail brands, you look right here.
Exactly. And that ubiquitous everywhere all at once scale is exactly why these specific results matter to everyone watching today. It provides a rock-solid leading indicator for exactly where the broader market is heading over the next few quarters. Moving right along to Section 2, driving top-line growth. Our thesis here is the top-line triumph. It's one thing to boast about a $177.8 billion top line. It's another thing entirely to understand the exact mechanics generating it.
We need to break down exactly where this massive influx of cash is actually originating.
Market skeptic? I'm completely ready for the drill down. Let's pull apart these business segments and see if the growth is genuinely broad-based or if there's a weak link hiding somewhere in those international divisions.
Well, here is the exact segment breakdown. Walmart US obviously remains the absolute bedrock of the company, bringing in $120.6 billion with a very healthy 5.1% constant currency growth. But you've got to look at the heavy lifting that's happening overseas right now. Walmart International generated $32.8 billion, delivering a massive 10.1% constant currency jump. While Max, which covers Mexico and Central America, also contributed a very solid $12.2 billion, which is up 4.1%.
Okay, I have to admit that 10.1% international growth is seriously impressive. It proves they aren't entirely reliant on the health of the American consumer. But we all know international markets come with intense currency risks and a whole host of different regulatory headwinds. Usually, a really strong US dollar absolutely wrecks international earnings on paper.
That's entirely true, and that is exactly why that constant currency metric you see there is so absolutely vital for our portfolio analysis. Let me break that down for a second. When the US dollar is incredibly strong, every single peso or pound you make overseas naturally translates into fewer dollars when you bring it back home. It acts as a massive drag on reported earnings. But the constant currency growth rate mathematically strips all that exchange rate volatility out of the equation. It shows you the actual ground-level operational strength. It tells us that despite a highly punishing foreign exchange environment, the sheer volume of goods they are selling abroad is surging by over 10%. That indicates a fortress level of global demand. Now, what's really fascinating here is the noticeable shift in consumer demographics. Look at exactly where these US market share gains are originating. Walmart's core value convenience proposition is now aggressively capturing upper-income households, specifically within the food and consumables categories.
See, to me, this is a massive tell regarding underlying market weakness. When upper-income households actively start trading down from their premium grocers just to shop at Walmart, it means inflation is biting absolutely everyone. The middle class is getting severely squeezed, and now even the wealthy are actively looking for safe harbors to defend their own personal balance sheets.
Precisely. Walmart is effectively acting as a defensive shield for these households right now. And here's the genius part. Once they capture these higher-income shoppers in the basic grocery aisle, they are remarkably effective at cross-selling them into general merchandise, like fashion, home goods, and beauty. Those specific categories are where the profit margins are significantly thicker, which dramatically helps to fortify their overall profitability. Let's pivot to Section 3, the digital profit engine. We are moving way beyond brick and mortar here. If you are watching this and you still think of Walmart merely as a collection of physical aisles and metal shopping carts, you are mispricing this asset entirely.
All right, lead analyst, this is exactly where I need some convincing. Because literally every retailer claims they're a cutting-edge tech company nowadays. I really want to see the hard numbers that prove this isn't just corporate window dressing. Show me the structural steel.
You want structural steel? Look at these 3 high-margin growth pillars right here. Global e-commerce didn't just grow a little bit, it surged by 26%. US marketplace sales practically skyrocketed by 50%. And global advertising, which is driven largely through Walmart Connect, spiked by an incredible 37%.
Okay, I'll give you that. A 50% growth in third-party marketplace sellers is a highly serious number. That means they are rapidly scaling an asset-light model where they just sit back and collect fees. But let's talk about those advertising margins for a second, because that's the real story here.
Let's be crystal clear about what this means for a portfolio. Think about selling a gallon of milk or a flat-screen TV. You've got manufacturing costs, global shipping, massive warehousing, spoilage theft. The actual profit margin on that physical gallon of milk is razor thin, maybe just pennies on the dollar. But selling digital ad space on Walmart.com to a major brand that desperately wants to be at the top of the search results, the marginal cost to Walmart to serve that single digital ad is practically zero.
You hit the nail on the head. That 37% jump in global advertising is pure, unadulterated profit dropping straight down to the bottom line. Management specifically noted that advertising and membership streams now represent around a third of their total operating income. They are rapidly and deliberately changing their entire profit mix, using these high-tech digital engines to do the heavy lifting for the bottom line. This is a totally different financial architecture than this company had even 5 years ago.
But here is the brilliant part. They aren't abandoning the physical world at all. They are fully integrating it. Look at this tech pivot. They are actively turning their 10,000 plus physical retail locations into localized high-speed distribution hubs. Today, 60% of the entire US population can now receive store-fulfilled deliveries in under 3 hours.
And that right there is the ultimate counterpunch to Amazon. By leveraging the massive footprint of physical stores they already built decades ago, they completely avoid the massive capital expenditure of building new last-mile fulfillment centers from scratch. But let's be real, logistics are still incredibly expensive. Expedited 3-hour delivery is notoriously difficult to actually make profitable. Is this fast fulfillment actually driving positive returns, or is it just a massive loss leader designed to grab market share?
It's doing both, but crucially, it's driving incredibly deep consumer engagement, purchase frequency, and most importantly, it's fueling the rapid growth of their Walmart Plus memberships, which just saw fee income grow by double digits. They're successfully figuring out how to monetize that convenience. And I want to show you just how deep this tech pivot really goes. Look at the data on Sparky, which is their brand new AI-powered shopping assistant. They've already seen a 100% increase in weekly active users. The actual units purchased through Sparky have quadrupled. And the metric that really matters to investors, average order value is a staggering 35% higher for users interacting with the AI.
Look, I am naturally skeptical of any company suddenly slapping AI onto their earnings call just to juice the stock price. But at 35% higher average order value, that is not hype. That is a direct, highly measurable expansion of the consumer's wallet. If this tool is successfully predicting what consumers need and actually building larger digital baskets for them, that is a highly durable competitive advantage.
Exactly. It is generating real, tangible revenue. Sparky isn't just some basic, clunky chatbot. It's an incredibly sophisticated predictive engine. It analyzes your purchase history, identifies your replenishment cycles, and uses smart pairing. If a customer adds ground beef to their digital cart, the AI instantly knows to suggest the taco shells, the salsa, and the cheese, dramatically reducing the friction of building a complete meal. It is systematically constructing larger digital baskets and removing the consumer's need to even remember what they need to buy. That translates directly into measurable wallet expansion and immense operational leverage. All right, Section 4, Margin Pressures and Headwinds. This is the antithesis to our bull case, the squeeze on profits. As Iron financial analysts, we don't just look at the shiny revenue numbers and call it a day. We rigorously inspect the foundational stress of the company. And despite those soaring top-line revenues, the bottom line is currently facing a gauntlet of macroeconomic threats.
Here we go. This is exactly where we find the cracks in the armor. You can generate $177 billion in sales all day long, but if the cost to actually move those physical goods is skyrocketing, your profit margins are going to get absolutely crushed. Let's look at the damage.
The damage is quantified right here on the screen, $175 million. That is the direct hit to Q1 operating income caused solely by elevated fuel and supply chain costs.
See, that is a severe structural blow. $175 million wiped out just to keep the delivery trucks running on the highway. That represents a brutal 250 basis point headwind to their operating income growth. This is the harsh reality of operating a physical supply chain. No matter how much of that high-margin advertising you sell online, if diesel prices spike, your distribution costs soar and your bottom line bleeds.
You're absolutely right about the pain there. But keep in mind, management deliberately chose to absorb this cost rather than instantly passing it on to the consumer. They are playing offense to protect their everyday low-price promise and grab long-term market share. But make no mistake, it's a heavy price to pay in the short term, and it seriously tests the durability of their balance sheet. Let's visually contrast this core tension for a second. Over on the left side, we had the top-line triumph, massive 7.3% sales growth and 4.1% U.S. comp sales. But then on the right side, you see the margin squeeze. Despite all that phenomenal growth, the consolidated operating margin remained completely flat at 4.2%, weighed down incredibly heavily by that 250 basis point fuel headwind.
So essentially, they are running significantly faster just to stand completely still. This is the exact type of market weakness we constantly warn our viewers about. Massive revenue generation is locked in a brutal tug-of-war against relentless supply chain and fuel cost pressures. The top line is an absolute beast, no doubt, but the profit conversion is taking a serious beating. If those fuel costs don't stabilize soon, that flat margin is going to crack, turn negative, and likely drag the stock down right along with it.
This brings us to our final segment, Section 5, the future outlook, resolving the tension. All right, the historical numbers are in the rearview mirror now. What really matters to the portfolio is the forward guidance. How long can Walmart realistically afford to absorb these massive costs before they inevitably have to break their pricing promise to the consumer?
Well, the answer to that comes directly from CFO John David Rainey. Look at this incredibly stark quote right from the earnings call. If the current elevated cost environment persists, we'd expect somewhat higher retail price inflation in Q2 and the second half of the year.
Wow. That is a massive red flag for the broader economy. If the biggest, most ruthlessly efficient retailer on the planet is throwing in the towel and warning us about impending price hikes, it means these corporate fuel costs are absolutely going to show up on your very next grocery receipt. They've absorbed all the pain they possibly can. The consumer is about to take the hit.
It's a highly pragmatic warning for sure. It grounds all this lofty financial jargon right back in reality. If the macro environment doesn't provide some immediate relief, Walmart will have no choice but to pull the pricing lever to defend its operating income and protect its shareholders.
But before we panic, let's look at management's actual playbook for surviving this squeeze. This is their strategic war room breakdown. First, they are projecting immense confidence by explicitly reaffirming their full-year earnings per share guidance of $2.75 to $2.85. Second, they are actively implementing 7,200 targeted price rollbacks to aggressively defend and expand their market share, even despite the cost pressures. And third, they're heavily relying on scaling those high-margin advertising and membership fees to directly offset the physical retail costs.
It's an incredibly delicate balancing act. When you look closely, they are essentially using the massive, high-margin gains from their new digital ad business to artificially subsidize the lower physical prices in the store. It's a very clever strategy, and honestly, if anyone has the fortress-level balance sheet required to pull it off, it's Walmart. But if the consumer finally breaks, or if global fuel costs suddenly spike another 20%, those 7,200 price rollbacks will evaporate instantly.
It's true, the pressure on them is immense right now, but their fundamental full-year financial framework, which is to grow operating income faster than sales, remains fundamentally intact. That shows real, undeniable structural durability in the face of chaos.
So it's time for the final verdict. We want to end today with this very provocative question. Is Walmart's evolution into a tech and advertising platform actually enough to permanently shield it from the harsh reality of global inflation and fuel costs? From my perspective as lead analyst, the sheer scale of their digital pivot, that 50% marketplace growth, that 37% ad growth, makes this stock a formidable, highly defensive opportunity in an otherwise weak market. They are successfully building an entirely new, highly profitable foundation.
And as the market skeptic, I'll just say this. The digital growth is undeniably impressive, but gravity still applies to physical goods. A $175 million hit from fuel costs proves that you simply cannot build a digital empire without physical delivery trucks doing the real heavy lifting. It's a remarkably solid company, but you need to tread carefully if inflation accelerates and starts eating into that core consumer demand. Thank you so much for joining us for this Iron Financial Explainer. We really hope this breakdown helps you forge a stronger portfolio and cut right through the market noise. We want you to think about the true structural cost of your very next shopping basket, and we'll see you all in the next drill down.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.